thousands of free dollars from US government. How's that?
Good. Yeah, and we are live here. Good timing. I'm live here with Jake Birnberg with second episode here of Industry Leader, a new podcast that gives small business owners, entrepreneurs who are industry leaders a platform to tell us about their business and present and connect with their ideal client. And today I have a good colleague of mine here in the East Bay area, Jake Birnberg, who's really a master of taxes and strategic tax planning. He's known as a deduction detective, and he actually gives free consultations. If you are looking to save money on your taxes, do reach out to Jake. We're going to put the links in the chat, but he'll give you a free consultation about, you know, if you are curious about what's coming down the pipe from the Biden administration. There was a bill just passed about and he's going to talk about the little known elements of this bill, which is ARPA. We'll go over the full name in just a second. That can help your business get thousands of dollars from the US government. And just a few more things about his bio. He graduated with a degree in finance from UC Berkeley Haas School of Business, has a background in investment banking and financial planning, where the key is looking forward to meet clients' needs for a lifetime and sometimes beyond. He worked for firms such as Dean Witter, Shearson Lehman, and Wells Fargo. He's an enrolled agent licensed in 50 states to appear before the IRS. And he has a book coming out titled The Capital Gains Playbook. And I'm going to leave it there for now. I want to get right to Jake. And Jake, thanks so much for being with us today. And really looking forward to your presentation. I know a lot of other business owners will benefit from this as well. So with that, I'll turn it over to you.
Sure thing. Great. Nice being here, David. Thank you so much. So we're going to talk today about the little known elements of ARPA, which is the American Recovery Plan Act, the American Rescue Plan Act of 2021. And this plan that can help your business get thousands of dollars from the US government, basically for free, if you qualify. So my job is to help people qualify. So I work with a lot of business owners to help them get qualified to take advantage of some of these free dollars that are coming down from the government. So, there's a lot of things that are very commonly known about the money that's coming down from the government. The most commonly known about is the $1,400 stimulus check. So basically, everybody and anybody who qualifies will receive $1,400 per person within your household for as a stimulus. So if you have 4 people in your household, you know, you get $5,200, 4 times 1,400. I'm sorry, $5,600. And so you can get a lot of money. It is limited to people who have income of less than 70. Basically, the phase out starts at $75,000 if you're single to $80,000. It goes down by 20% per $1,000. Head of household, it's 112,500 to 120,000. Just goes down between those two figures. And married filing joint, 150,000 to 160,000, and it just goes down as you approach the higher level there. And so you can, so this is a place where some planning can help, especially if you're a business owner. If you're a W-2, there's very little we can do here. But if you're a business owner, there are things that can be done to try to get your income within the scope of what these numbers are if you're not too far away from them so that you can qualify. For 2020 only, you can get, if you had unemployment insurance last year, if you were on unemployment, you can get $10,200 of that unemployment without being taxed on that money. And again, the phase outs are the same. So 75,000 single to 80,000, head of household 112.5 to 120, and married filing joint is 150 to 160. But that just means that there's some money there that you could have earned and not have to pay taxes on it. Normally, unemployment is entirely taxable. For 2021 only, there's a child tax credit increase, and this is a huge increase. It goes to $3,000 per child. It's normally $2,000 per child, but there's other things that make it even bigger than that. So there's a $600 bonus if your child is under age 6. So 6 and above, it's $3,000. If they're under 6, you get $3,600. This is now a fully refundable credit. It didn't used to be. Refundable credit means that if you don't owe any taxes, if you don't have a tax liability at all, then the credit is lost. If it's a refundable credit, you're going to get a tax refund on this credit, even if you don't owe any taxes. So this opens the door to people who have very little income get some money. And so this act has by itself reduced poverty in childhood by about 40% in this country. So it gives you $3,000 per child, $600 bonus if the child is under 6. It expands to age 17. Normally, it's only available for kids who are up below 17, but now it includes age 17. And there's no more earned income requirement. Used to have an earned income requirement. So this is huge. Again, same phase out numbers as before, 75,000 to 80,000 single. Well, there wouldn't really be any single people, but head of household as 112 to 120, and married filing joint is 150 to 160. If you go above those numbers, as long as you're not over 400, you still get the $2,000 child tax credit, which was in place before they passed this. And then that phases out accordingly afterwards. Again, for 2021 only, the child independent care tax credit is increasing from $3,000 per child to $8,000 per child. So you can get a credit on up to $8,000 per child, or $16,000 per family now. It used to be 6. And that credit is going from 35% of what you've paid in child care to 50% of what you've paid in child care. So you could actually receive 50% of 16,000 if you have 2 kids and you've spent 16,000 on child tax credit. Then you can actually get $8,000 in a tax credit right here. This phases out for every $2,000 you earn over 125,000. It phases out 1. And it goes down, and that's until it reaches 20%. And then it stays at 20% until your income reaches 400,000, and over 400,000, it phases out 1% for every $2,000 in earnings until it reaches 0. So that's basically kind of where it is. So if your income goes over $440,000, there's no child tax credit, no child independent care credit. So this is separate from the child tax credit. Child tax credit is just for having a child. Child independent care credit is for you if you have child care for your child, and in order to get this credit, both parents, or if you're a head of household, you need to be working. If you're married, both parents need to be working or have some income anyway. This is a huge change here, the ACA payback. So the the Affordable Care Act, which is also known as Obamacare. If you have, normally what happens is you get a health care plan, you tell them what your income is going to be. If your income goes over what you've told the government it's going to be, you may have to pay back the tax credits that they're giving you the subsidies they're giving you to make your health plan cheaper. Those are subsidies that are paid in advance, and normally you have to pay them back. In 2020, if you went over, you do not have to pay back any of the subsidies that you've received from the ACA. Going forward for 2021 and 2022, they've eliminated the top tier of 400% of poverty line, which for a single person is about 51,000. For a family, it's more like 65,000 for a couple. So they've eliminated that, and now you can have income that goes much higher than that, and the most you have to pay is 8.5% of your income towards health insurance. And so they take the 8.5%. So if you made $100,000, then you would be responsible for $8,500 over the course of the year. And they would divide that by 12, and that would be what your monthly spend would be required of. Then they take that and they compare it to the second lowest silver plan, and however much that silver plan is, whatever it is to get it down to that amount. So 8,500 divided by 12 is $708. So that's $708, and basically if the plan costs $1,208, you would get a credit of $500. And then you can get any plan you want, and you have a $500 credit. So you can actually get the cheapest plan available, which might be about $800, and get a $500 credit, and then your cost for health insurance is only $300. So it really helps a lot of families who where your income is just over the line, just over the 400,000, because otherwise, you know, your payments for health insurance over 400, if you're over that line, can be as much as 20, 30%. So this really helps. It helps especially the older people. The older you get, the more expensive your health insurance is. So it really, really helps a lot of people. So this requires some planning now, because now we're looking at like, well, what are you going to do if you have insurance someplace? Or what do you do if, you know, in terms of should you offer insurance if you have employees? Now, student loans. There isn't really anything right now about student loan forgiveness, but they're looking to do that sometime in the future to forgive some debt. And so they've put in this law that any debt that's forgiven in terms of student loan between the end of the beginning of this year through 2025, that there'll be no charge for that. There's no tax resulting from student loan forgiveness. Employer paid sick leave and employer paid family leave credits are now extended to September 30th of 2021. This is huge, and you can get this even if you're self-employed or if you're a solo officer of a company. You have your own company, you can even pay yourself this. So if you've gotten sick, if someone in your household has gotten sick and you needed to take care of them, stay home to take care of them, as long as you couldn't telework, and you're staying home because you're sick or someone in your household is sick, you can get a credit. Okay, so if you earn $26,000 a year, it's basically 126, so you get $1,000 credit. It's basically up to $511 per day, and you take whatever you're earning divided by 260 days. That's how many days there are in a work year, excluding holidays, and so that's the formula. Basically, if you're making $100,000, you would divide that by 26. By 260, I'm sorry, and that's $385 a day. You can multiply that by 10, and that's $385 $3,850 credit for taking 10 days. You can take up to 10 days to either you're sick or someone in your household is sick. In addition to that, you can take the family leave credit, and that's up to 50 days. And that's if you have a child who lives in your household who is home from school and you have to care for that child. You get up to 50 days of pay. It's only 2/3 of your pay for that. But this is a tax credit. So that means that you're paying yourself that amount and you're getting it as a credit on your tax return. So there's no taxes on this money. You do not have to pay tax on that money. It's like free earnings that you don't have to pay any taxes on. And it's great that it's eligible for people who are self-employed. One of the only things that's really good for the self-employed. And then there's the employee retention credit. Now, this has been hugely expanded. Previously, this existed under the two acts from last year, the CARE Act and the second CARE Act, I forget the name right now, but they both included this. However, in order to get it, you basically were, if you got a PPP loan, you wouldn't be able to get this. So it was either a PPP loan or employee retention credit, and you had to decide which. Now, if you're self-employed, for purposes of this credit, your wages don't count. If you have an actual employee who you pay, that counts. And so if you have employees, then you can get this credit if you qualify. Now, there's two ways to qualify. The first way is if your business was shut down by the government, federal or state, if you were considered a business that needed to close. So if you were a restaurant, if you did massage, if you were a hairstylist, any number of things. If you weren't considered an essential worker and you were shut down, you qualify for this for your employees. And for 2000, so that's one way of qualifying. The other way of qualifying is if your income changed from year to year. So if in 2020, your quarterly income for any given quarter over the prior year's revenue for that quarter, if you were down by 50% or more in 2020, you would qualify for that quarter and the next quarter. So you can actually get this credit. Now, for last year, for 2020, the credit was it's 50% of up to $10,000 in wages per employee. Now, in 2021, they've expanded it, and it is now 70% of quarterly wages per employee up to $10,000 in wages. So you can actually get $7,000 per employee per quarter for a total of $28,000 in a tax credit. And it maxes out at $50,000 per quarter. So you can actually get $200,000. You can up to $200,000 from the government here, which is, it's just huge. It's huge. The other change that they've made here is that if you were not in business in the first quarter, before February 15th of 2020, you can get this without the comparison. You just get this. You're considered a new type of business, a recovery startup business, and that gives you the qualification to receive this credit. Okay, so you can actually receive this credit on your employees, on whatever you're paying people. Okay, now this interacts with your PPP loans. So if you've already received a PPP loan, then you have to use the funds in order to get the PPP loan forgiven. You're going to be using those funds to pay your employees. So you can't you can't double dip and use the same wages for both purposes. And this is where planning comes into play, because we can plan around this. And if we plan this right, then you can get both this credit, the employee retention credit of up to $7,000 per employee per quarter, plus forgiveness on your PPP loan. But it takes some planning, both to qualify to receive this. If you're not qualifying, if your income is over the line, or if you haven't received, if you're not quite at 50%, there's things we might be able to do to help you plan and to actually qualify for this. And if you have a PPP loan, once you qualify, to be able to use the dollars that you are paying out so that you qualify for both the forgiveness on your PPP loan and this credit, so that you can get both. So it's very, very important to have some planning around that, because otherwise, without the planning, you may only be able to take one or the other. Okay, and the PPP loan is great. The second PPP loan is great, but if you've gotten a PPP loan, then you have to use those funds for to get the forgiveness. You have to use those funds to pay your employees. So there's planning techniques that we can put into place to help you get both. And so that's what we do. Is also retirement planning types of things that we do, where we help you maximize the amount. If you're earning a fair amount of money, we can maximize the amount that you can get for retirement planning. People think that the max is $56,000 a year, and quite honestly, we've gotten people up beyond $250,000 a year that they can put away into retirement plans, and that makes a huge, huge difference in your current taxes. So, and a lot of times that will enable you to get qualified business income deductions of 20% of your remaining income that you might not have otherwise qualified for. So we've helped people get deductions of about $60,000 in addition to the deduction on the money that they put away in retirement plans, just by setting up the right types of retirement plans. So that's basically most of my presentation. The way that my service works is a lot like going to the doctor. We do a no-cost tax return examination. You know, you go to a doctor, you get an exam. Then we diagnose the problems. You know, we look for any kind of mistakes and missed opportunities. I do that exam. I don't charge for it. We do a tax diagnosis and come up with types of things that are problematic. And then we do a cost-benefit analysis to come up with a prescription for a tax plan, like what you need to do in order to, I mean, do you need surgery? Do you need a prescription? What do you need, you know, when something's wrong? So we come up with that for purposes of your taxes. The result of this process is usually savings of 20 to 40% of your taxes. So if you're paying, you know, $50,000 a year in taxes, we can save you between $10,000 and $20,000 a year in taxes. So what would you do if you had an extra $10,000 a year in income? What would you do with that money? Because we can help you get that. So if you want to go diving, you know, off the Galapagos Islands, if you want to go throw a big wedding for your daughter, if you want to go buy yourself a Tesla, these are the types of things that my clients have done with their tax savings from tax planning. So, so what we try to do, you know, in the process of not only do we save you the money, but we can implement the plan for you. So it saves you a lot of time. We make life easier for you by doing a lot of the ongoing paperwork. We're a full service firm, and we have a guarantee. So we guarantee your results of at least 200% of our planning fee in the first full year of your taxes. So if we started a plan now, the first full year would be 2022. And we'd probably get you some savings this year, but next year we'd get you at least twice as much. Usually it's more than that, but at least twice as much as what our fees are in tax savings going into the following year. So that's pretty much it. You know, if you want to get in touch, if you're interested in a free consultation, you can just give our office a call or send us an email to admin@deductiondetectives.com. Just send an email to that and say you want a free consultation, or tell us you want to sign up for our newsletter. And if you contact me for that, we will get you an appointment, or we'll get you on our list to send you our list, our information. So you can phone me, you can email. We will set up a portal for you so that all of your information is very private and secure. And you're welcome, of course, to share what you've learned today with others. Anybody you know who might need our services. If you don't have employees, but you know somebody who does, many businesses do qualify for this, and it's huge. It's a huge amount of money. It could be up to $200,000 a year. So that's about it for my presentation. David?
Great. Thank you. Great presentation, Jake. And if you don't mind just stopping the share so we can go back to the gallery view. Okay, great. And very timely topics there. I think a lot of people may not realize, and correct, I like to kind of try to get to the bottom line, but I actually used to work in the tax field as a lobbyist. And, you know, to me, that looks like it's probably the most significant tax bill for, you know, working families and middle class that we've had in my lifetime. I don't know if you would agree with that assessment, but those are some pretty impressive tax benefits that you actually have to know how they work and how you can use them. Otherwise, they just stay on the table. Would you agree with that assessment?
Yeah, it really is one of the biggest tax changes and overhauls in history. I think the Biden administration is looking towards extending, especially the child tax credit and dependent care credits. I think they're looking to extend those and make them permanent, but they have not done that just yet. And that, I think, is something that they want to have more buy-in from, you know, both sides of the aisle. They don't want to make that a unilateral type of thing. So, but I think those are things that they are looking to do. And if they do make that permanent, I mean, that by in and of itself, that cut. Oh, and there were some other changes in terms of making it easier to get the earned income tax credit, which I didn't cover. But those changes cut the number of people who are going to be in poverty by 40%. It's amazing. It's really amazing. So they've done some great stuff there. And a lot of this is temporary, and we'll see what they do going forward. There are also some tax increases that I also didn't mention because they don't affect most people. They only affect CEOs and the top 10 people, the top 10 compensated people in corporations are now limited to $1 million in compensation. So that's how they're paying for all this.
Okay. And I know you alluded to more to come, but could you tell us a bit more about what we might see coming down the pipe in the next year or so with the Biden administration in terms of tax treatment?
Well, I can tell you a little bit about what they're talking about. And this is all completely, like, we have no idea what they're going to actually do and whether they can pull this off or not. They're talking about getting rid of the 1031 exchange. So if you own real estate and you bought real estate, say 20 years ago, and it's gone up, you know, eightfold between 10 years, 20 years ago and now, and you want to sell that property, one of the ways you can sell that property, if it's commercial property, or if it's property, rental property, if it's for business use, you can do a 1031 exchange and buy another property with that money, and not pay any taxes at all. And they're talking about getting rid of that strategy. Fortunately, you know, I've got about a dozen strategies you can use to sell property, to sell a business, and not have to pay those taxes. Right now, 1031 exchange used to be available for businesses. It's no longer is available for businesses, but we have other strategies available for people who are trying to move out of their business if they're going to sell a business. They're talking about getting rid of that. They're also talking about getting rid of the step up in basis. So if you bought that property for $500,000 and now it's worth a couple $1 million, for people, when you die, that property gets stepped up in basis. So it goes to your heirs with a value of the $2 million. You're talking about getting rid of that so that it passes on to your heirs with the same basis that it had before. So between these two items, that's a huge change in the landscape of what you're going to do to kind of, it forces you to pay the taxes on the properties when you sell them. So we do have strategies to help avoid either and both of these things. And so these are two of the things they're talking about. They're also talking about changing the top tax tier from 37% back to 39.6%, which is what it was before the Tax Cuts and Jobs Act that Donald Trump and the Republicans put through in 2017. So those are some of the things, you know, the bullet points that they are talking about doing. And we have no idea. It's hard to speculate whether they'll be successful in doing any of this.
Great. And I know the one thing that I really see that's unique about you and your business is I feel like a lot of these strategies are really just reserved for the ultra rich, but you really kind of bring this to kind of more average or, you know, small business, maybe million, maybe 10 million in revenues. But some of these strategies that you do just in your knowledge, and that you offer this guaranteed results that you're going to save this 10 to 40% in taxes. And I just don't see that out there in the marketplace. So I think that's why I see you as a industry leader, a lot of other things that you do about your business. Could you just, I don't know if you have anything to add there about how you're unique as a tax strategist compared to just kind of a CPA doing the book, so to speak?
Well, I think a lot of it has to do with my background and training. You know, most CPAs have a background in accounting, and they study accounting in school. And when you study accounting in school, the primary purpose, the primary directive of accounting is to make sure that the numbers are correct. Now, and I'm not saying that's not important. It really is important. And we do that, you know, we do make sure that the numbers are correct. But that's really where they take it, is like it's all about compliance. It's all about what happened and how we're going to record history. That's the general mindset of an accountant. I didn't study accounting, I studied finance. When you study finance, you have to know a certain amount of accounting just so that you kind of can understand what the accountants are saying and understand what earnings are, understand the balance sheets and the cash flow statements. You need to understand all that stuff. But that's not where it ends. Where it ends is how are you going to invest your money? And what we are trained to look at is we're looking at everything through the lens of an ROI, of the return on your investment. So you're going to make a certain investment. So, you know, when you get your taxes done, you're making an investment in your tax advisor. And basically, he's not just preparing, ideally, he's not just preparing it, but he's looking at it with the eye of like, how can we save money on these on taxes here? And most of them just record it the way it is, and that's it. They might come up with a couple of deductions that you could have taken last year, but no matter how good you are with a pile of receipts on April 15th, if you didn't plan ahead, there's certain things you just can't do. So we like to plan ahead because we know that every strategy costs some money, but we do a cost benefit analysis and we look at the ROI of your investment, and you can always guarantee that in taxes that we can take care of that and we can actually get you these deductions. Assuming your income stays the same, then you're going to be able to save a certain amount of money on taxes, and we can guarantee that. And we're very comfortable guaranteeing.
And from what I understand, you also do some very unique things with business structure to save on taxes that probably a CPI doesn't have any idea about. Could you just talk a little bit about the importance of business structure and how you structure your business and some of these maybe future transactions that business owners might be looking at in this
Yeah,
environment?
sure. I mean, that's one of the things that we do is we see, are you structured appropriately, So if you have an LLC, well, there's 4 different ways you can report your taxes on an LLC, and are you using the right one? If you don't have an LLC and you just started your business and you just kept going in business and you never really did anything to set up a structure, you're going to be a self-employed individual. And that is taxed in a certain way. And, but you can also be an S corporation or a C corporation or a partnership, and they all have different deductions available to them. They all have different rules of how you file them. They all have different rates of being audited. And we do a full analysis of what the best business structure, and that's part of our tax planning. And that's why we charge for it, because it takes a fair amount of time to go over all of that for any individual who's in business to see, given their level of income, their expectations for future income and future growth, that we want to make sure that they're going to be in the right kind of structure to use that. And sometimes you want to have more than one business. You want to split out what part of your business into a completely different structure so that you can take advantage of multiple types of things that are there. And of course, that depends on your income. You're usually not going to do that if somebody makes $50,000 or $60,000. But if somebody who has a significant amount of income, you might want to break up their business into multiple businesses.
Excellent. And if folks did miss it earlier, you do offer a 30-minute consultation where you'll also look at doing a cost benefit analysis to see how much you could potentially save people, because you don't like to take their money or to take money from people who you can't help, and you're very straight shooter in that respect. I did want to ask you about that consultation, where they can get started with you, but also who your ideal client is. Who are you looking to work with?
Well, basically, the first thing is I'm looking for people who are struggling with the amount of taxes that they have to pay, and they don't like paying that amount. And people are earning, upwards of $60,000, $100,000, because then that's where costs, the cost benefit analysis starts making sense. Okay, if you're making $40,000, then there's really not enough that we can save you to overcome the costs of the planning, the cost of the strategies that we would need to put in place. But if you're making $100,000, $150,000, $200,000, then there's a lot of things we can do and the costs, the savings would be significant enough to make sense of the whole thing and make it make sense to actually do the plan, to make it make sense to actually change things and get the types of benefits that could be available. And, you know, right now, where business owners who have employees are just in prime space because, you know, of these tax credits. And businesses that have employees that started after 2/15 of 20, new businesses, are eligible for these huge credits. So, but you have to know how to kind of plan accordingly so that you can get the credits and get the PPP loans and make all that stuff play nice with each other.
Great. Well, I think we're going to leave it there unless you have any additional comments, but I want to thank you for coming on again to share on such a timely and important topic. And I think really, you know, if you are in that range, that's a huge savings, what some of those numbers that you talked about that you save your clients. So that can be just
the other thing that I could say is that, you know, there's the concept of a family office, which is usually only available to people who have, you know, tens of millions of dollars in income. And we have a version of that is a mini family office where we take care of all financial needs for someone where their income is much lower. Okay, to see if that makes sense for them. So, and we look for all of that stuff for people whenever they come in for the consultation. We look at, you know, what can we save you? Does it make sense? You know, basically, are they going to qualify to work with us? Are they going to have a significant enough savings for it to make sense for them to work with us?
excellent. Well, we look forward to keeping in touch, Jake, and having you back at some point when there's some new things to report or new analysis to do. And if folks do see themselves as an industry leader, I am opening the broadcast to just a limited number of folks who potentially qualify. So reach out to me and I will put the links to how to get a hold of Jake and his business and contact info. And thanks so much for coming on today, Jake.
Thank you so much for having me. I really appreciate it, David. I think you're doing a great service by having these meetings. I think they're really great.
Great. Thank you.
Okay.
Have a nice day, everyone.
Take care.